Let's bring in media trailblazer and CNBC contributor Tom Rogers. Tom served as NBC cable president, now executive chairman of Oorbit Media and Entertainment. Tom, it is always great to see you. Welcome.
Always great to be here, especially to talk about Netflix.
I know you've loved it for a very long time. You've always said that it's Netflix's world and everybody else lives in it. Are we getting too bulled up, though, ahead of the print? I mean, is at least short term a concern?
Well, I don't think this quarter is a concern. A guy likes to throw around the word stud for some reason, S-T-U-D. It applies to Netflix, staying tough under a downturn. And I think it can stay tougher under a downturn than just about any other media stock for good reason, which is that it's only got about 4% of its revenues that relate to advertising. And advertising, of course, is what will get most hit in a recession. And when you look around, whether even if you're talking about guys with great growth rates like Facebook, who probably get 98% of their revenue from advertising, they're all going to get hit. With Netflix near term, that doesn't mean much to their top line. Obviously, over the next 5.5 years and getting to $1 trillion market cap, advertising has to perform very well, but because they are more defensive, they're not going to be digging out of a hole if the downturn comes, relative to what kind of hole I think most other media stocks will probably find themselves in.
Tom came up with his own acronym. I like that. You've had 24 hours to think about this $1 trillion market cap. I mean, if you were in the seat, how do you get there? Because I'm sure you have some thoughts about that.
Well, I don't really think it's that hard to get there. You probably have to get to about 400 million subs, which is 100 million more than they currently announce, which is 20 million a year. Remember, last quarter, in the quarter, they did just about 20 million. This year, though, they're looking on a trajectory as if they'll get pretty close to 30% margins, EBITDA margins, and getting to 40% EBITDA margins in 4.5 years is probably eminently doable. I would say their advertising business is going to have to take off. It's going to have to scale. But Netflix is a scale player, and scale begets scale. And they're already getting upwards of 45 to 50% of their new subs coming in on advertising, getting to 25% of their subs by 2030, or 100 million subs, which will give them plenty of advertising scale, gives them the ability to really drive high margin revenue coming off of what is a new revenue stream for them. So you put those variables together, and they're probably tripling their bottom line and doubling their top line, and at the kind of multiples that don't have to look quite as extended as their current multiples, you get to $1 trillion. It's basically doubling what their February high was in terms of their market valuation. The market as a whole over that period of time, if historical trends hold, probably up 70%. For Netflix to be up 100% from its high is probably not a huge reach.
Oppenheimer had a note out, Tom, saying that in the past recession, 2008, 2009, people actually increased TV time at home, and that bodes well for Netflix. Assuming that is correct, that people will increase TV time should there be a recession this time around, does that enable other players to gain any share if the pie is just bigger?
Yes, it does. I'd say the one caveat to the analysis I just laid out is that Netflix engagement has to stay strong. Engagement is what drives pricing power. Engagement is what will drive their advertising revenue. And relative to January, when Netflix was about 8.5% of all viewing time, they dropped below 8% in the March numbers. And the real beneficiary of that was YouTube and the free streaming services, the so-called fast channels. So, free is going to do very well in any kind of downturn. Netflix has to hold its engagement. That was a little troubling, and if there's one area of trouble that I expect them to address on the earnings call on Thursday, it would be that.